Africa's financial systems have progressed over the past several decades, yet liberalization, privatization, and stabilization have yet to translate into more accessible financial services, especially credit, that reaches the majority of Africans. On average, banks across the continent are well capitalized and liquid. Still, the benefits of deeper, broader, and cheaper finance have not yet been fully reaped. Across the continent, over 400 million financially excluded adults are missing out on opportunities to secure and grow their savings, to access loans to support their households and businesses, and to use insurance services to protect their households and livelihoods. At the same time, even among the Africans who have access to formal financial services, there is a sometimes reluctance to use them. So how do we deepen financial inclusion across the continent when we know what the issues are? And let's not forget that the definition and measurement of financial inclusion increasingly has progressed from categorizing individuals according to a simple scale as either included or excluded to observing financial inclusion as multi-dimensional. Joining me now is Yomi Adedeji. He's a co-founder of Softcom Limited. He's also the co-founder of Eyowo, one of Nigeria's top digital finance and investment platforms. Yomi, welcome to Business Edge. Thank you so much for joining me.
Thank you, Tolu. Thanks.
So as I said in the intro, one thing we can recognize now is that the definition of financial inclusion has changed over the years. It's now much more multidimensional than being just straight black and white. In terms of this definition and the work you've been doing with Softcom Limited, as well as what you're seeing when it comes to Eyowo as well, what definition are you working with when it comes to what it means to be financially excluded?
Thanks, Tolu. I think you're spot on when you say that. I mean, financial exclusion in itself is multidimensional, and there are various forms of exclusion. I think in terms of like what are we saying, I think there are first of all a group of people who, because of lack of education, the location where they live in, possibly in a rural area, also because of their socioeconomic status, are unwilling or unable to access financial services. And we can refer to that group as the first group, the excluded group. And there are those who now have access to financial services. They live in urban areas, possibly educated, in some cases gainfully employed, formally or informally, but have just minimal access to the services that they really require. So they are served, they have access to financial services, but they don't have access to everyday solutions to their money problems. So they want to access a loan if they're a small business, they're unable to access a loan. Or they want to make plans for the end of the year, from the beginning of the year, they're unable to save appropriately as the case is. So these two groups broadly are what we can refer to as those who are experiencing financial exclusion in one form or the other. And I think from the work we're doing, we're attempting to address it from a literacy point of view. And literacy affects both groups. In both groups, you find a scenario where even though people have access, they may not know what they need to do when it comes to planning money, thinking about money, and making the best use of money as the case is.
Very interesting. So, when we look at this, we hear the reports over hundreds of millions, around some 400 million Africans are estimated to have been financially excluded. And so when we look at it, we tend to look at them, but then also let's look at the cost to them themselves and also to African economies, where we have these hundreds of millions of people being unable to access money, to being unable to have access to financial services or even any small attempts of credit, as we might consider it. What does it cost them? What does it cost African economies across the continent to have so many people not being part of our financial services sectors?
I think the cost is quite gruesome, if I may say. I think it's on a couple of layers. I think the first is the ability of these economies to not be able to benefit from a huge population. So if you think about Nigeria as an example, from a population of about 200 million people, because many people are excluded from access to finance or not included in any formal means of financial services, society can't really benefit from them being part of their population. They wouldn't be able to pay taxes, as an example, and these taxes would typically be used to develop society. I think the second part of it is just poverty, just the sheer level of poverty within these economies. And one of the key promises of financial inclusion in itself is some sort of economic opportunity, some sort of like shared prosperity. So you have these economies who are suffering from, first, just an inability to gain value from a huge population because of financial exclusion. Second, also just a sheer amount of people who are suffering or who are like living in abject poverty also as a disadvantage. And I think just in general, an LD financial ecosystem pretty much inspires progress. So all of these economies that are suffering from this level of exclusion are unable to benefit from, or basically suffer these three key problems for exclusion reasons.
So in reading about this and talking to other experts, one of the criticisms of attempts to include those who are outside informal financial services is that oftentimes solutions are not designed to actually address the needs of the poor, or to address the needs of those who are excluded. Oftentimes, people want to sort of force solutions, force ways around this on the people, not really listening to those who are excluded to talk about how to bring them in, quote unquote, from the rain. When you look at the work you've been doing and some of the feedback and the results you've been getting, how have we been getting it wrong when it comes to addressing financial exclusion on the continent? You can even use Nigeria as a case study.
All right, thanks, Tolu. I think that if you think about it, every business or every company operating in the financial sector is doing so also for the purpose of building business for profitability reasons. If that is the case, what you find is that there's really no incentives. There are really no incentives for people to operate at the bottom of the pyramid, which is where you refer to as to provide financial services for the poor. If you think about the cost or what does it require to bank someone who is poor or in some way not socioeconomically stable or just even socioeconomically excluded, you find that the attendant profits or the attendant progress you can make as a business is very minimal in comparison to banking the educated or banking those who are in some way digitally included or have some level of literacy to understand the service you're providing. So how have we been getting it wrong? I think first is that our focus has been on the efforts and not the outcomes. For government initiatives, development enabler initiatives who have attempted to encourage financial inclusion, they've rewarded efforts to do so, but not necessarily outcomes. And what the outcomes we should be rewarding should be people are now accessing financial services, people are now utilizing financial services, but also people are now using it in a very LD way. I'll say that's one way I think we've been getting it wrong. The second thing really is that there is no policy to inspire or incentivize those who are in business to go deep down. As you know, if you plant a corn, as an example, you will typically have to nurture it till it gets to a point of growth. And when it comes to those who are excluded at the bottom of the pyramid, we need to take a long-term perspective to including them. We need to get it beyond just letting them transact or giving them access to tools. We need to pretty much invest in, or how do we make sure that the literacy required for better understanding is there. The technology we're providing for them isn't forced on them, just like you said. It meets them at the point of their needs. It doesn't require them to change their behaviors. It doesn't require them to learn something new. Wherever they are, they can begin from there. I think these are the ways I think we've been getting wrong in relation to solving the financial exclusion problem. Yeah.
So I like the fact that you brought up policy. It was one of my later questions, but I'll move it up now because we've seen new technologies. These things are rapidly changing the face of finance. They're breaking up financial services into smaller components. We have giant retail companies, electronic money issuers, major tech, and even social media networks, as well as fintechs who are making their forays into the financial services sector. But in terms of policy and regulation, what do you think the role is? You talk about not having a policy that sort of gives incentives for those who want to create solutions to these problems. And it's not to say that because they're not in a formal financial services sector, they haven't been accessing financial services. There are traditional ways. Of course, we know all of the Kolo and, of course, some of the Ajo that we see here. Different African countries have different names for these things, but it's more about the formalized parts of the sector. So in terms of policy and regulation, where do they come in play when we want to talk about giving an opportunity to deepen financial inclusion across the continent?
I think the policymakers and those who are regulating the space have a fundamental role to play in solving the problem. I think that one of the new responsibilities of governments world over should be to ensure that its population can access financial services and in some way get on the ladder of financial progress. For the policymakers, it would be nice to see policies that encourage fintech companies, people who are nimble, low cost, they can build very quickly, they can personalize products to peculiarities of people, get incentives to go do so on the long run. So, for example, are there tax incentives that they can provide for companies who are operating within the space of financial inclusion? Are there other social incentives they can gain from ensuring that many people go from exclusion to inclusion? So I think the policymakers thinking through what are the things that will drive two key action. First, an action from the business community to take ownership of this problem, because it's been with us for a very long time, and largely shouldn't be a problem that government should be solving. Government should just be trying to enable other people to solve it. So what is the policy to encourage a businessman or a business to go and take a long-term perspective towards driving financial inclusion and providing services to people who are at the bottom of the pyramid? The second role I think government can play is also to encourage the behavior of our people. So are there incentives we can create, for example, when people do things within the financial services ecosystem and not outside of it, like we have today with cash as an example. So if you were not banked before and you are now banked, and you kept a bank account for a couple of months, does that mean you now have access to a cheaper loan? So what are incentives government can create to encourage also the behavior of those who are at the bottom? Because, I mean, largely financial services is available, also mostly accessible to most Nigerians, especially because in almost every community you get to now, you find a mobile phone, you find some sort of access to connectivity. So availability and accessibility is gradually being solved. Clearly, there's still the problem of what is available, what is accessible, and what is the quality of it. But if the policymakers would want to see a scenario where this problem is faced head-on and is eventually addressed, it would be nice that there's policy to encourage the business community, also policies to encourage those who are at the bottom of the pyramid to use these services and to ensure that they can grow as the case is.
So you mentioned something I find interesting, which I'm going to bring sort of to the Nigerian situation right now. That's sort of getting government or the policymakers or regulators to find a way to incentivize those at the bottom to get into the system. And we've seen a situation right now where Nigeria is on this cashless policy drive for over a decade now. We've seen what's happening currently. We'll get to that. But does financial inclusion necessarily mean cashless? Can't financial inclusion also mean that we're doing things differently, but bringing people in to the fold? Must it necessarily come together as part and parcel of a cashless policy drive? Are they one and the same necessarily, especially in the 21st century?
Okay, really interesting question, Tolu. I think the first thing to do in a bit to answer this question is to dimension financial exclusion itself. I think there's the side of what is available, like what do we have available for people to use, either from banks or mobile wallets or fintech companies who are in some way addressing one problem or the other. The second question is what is accessible. So even though it's available, are people able to access them? And when we're done with access, we think about what is the quality of what they're accessing. Will it basically solve their problems? So I wouldn't say cashless policy personally means financial inclusion. I would say that cashless policy means, what it means is that money is now moving electronically. It doesn't mean that people are now financially included, because if people are still unable to access the problems that they have around financial services, which is around money, then they're still suffering from one exclusion or the other. We can do things differently. We don't have to take the template of the world. We can create our own template, and we can focus on where have we succeeded. So I'll give you some examples. So banks have existed in Nigeria for almost 130 years now, and they've just been able to reach about 56 million people. About 50 million people have BVNs, which means those are the people who can open accounts. As you know, all of us have multiple accounts, but if at the unique level, it's only about 56 million people who have been able to gain access to formal banking services. But if you look at the telecoms side of things, telecoms is barely 3 decades, barely 30 years, just a fraction of how long banks have existed. And there are almost 100 million unique people with mobile phones. So what it means is that people value even communication more than they value financial services. And this isn't always the case if you think about the world over. So if we're seeing that people are connected to their mobile phones, they find their mobile phones as a means of livelihood, as a means of access to economic opportunities, access to their families, Can we bring financial services to the mobile phone? I personally believe that the only way to achieve any form of equity when it comes to financial services or to eventually solve the problem of financial exclusion is solely through the mobile phone. It's already in everyone's hand, and because it's already in everyone's hand, it means that they can start from there. We always ask them to go get an account number.
Yeah.
That's what we always tell everyone to go do. Get an account number, start access to financial services. But they already have a phone number with them. Can this phone number become almost as a means of, as a financial ID? Can we start to enable them, even from where they are, without necessarily having them to learn a new number or to cram a new number? So I agree with you. I don't think the cashless policy in itself means that we've now addressed financial exclusion. It just means that money is now moving electronically. But the problems people have, which is still lack of access to the real solutions they need, economic opportunities for progress, and just things that enable economic growth for a person and a society is still largely lacking. Yeah.
So it's interesting because when we look at all of this, financial inclusion is such a vital part of Africa's sustainable economic growth. It's even a very vital part of about I think 7 of the SDGs as well, because it's a building block, and the United Nations and other countries globally recognize that financial inclusion gives people access to so many things. You can see that it's a building block to ending poverty, zero hunger, good health and well-being, even gender equality. There's a gendered aspect to financial inclusion, decent work and economic growth, industry innovation and infrastructure, as well as reduced inequalities. But when I come back to Nigeria again, I'm going to bring you back here because what we've seen in the past few weeks, particularly with the revised cash withdrawal policy of the CBN and now the redesigned policy of the 200, 500 and 1,000 naira notes, is that the system was simply not prepared to withstand the deluge of people. But Nigeria has been on a cashless policy drive for over a decade now, starting I think January 2012. And when you look at it, it's like you want people to come online, you want to move more transactions onto the internet, onto the online space. But when that happens, the system simply wasn't prepared. So the question now is, particularly in this instance, how could Nigeria have better handled it? When we look at Kenya, East Africa's largest economy, it's also one of the countries around the world that has the most online transactions and e-transactions of any other economy, of economies across the continent. They seem to have gotten it right. What could we have done better to prepare for what we've seen? It's been a litmus test, and unfortunately the system, by many standards, buckled under the pressure and failed.
Yeah, I think it was quite sad to see that after many years of investing in inclusion and in the idea of a financial ecosystem that is digitally enabled, at the first trial of people attempting to migrate to digital because of cash was becoming invalid, or a particular naira note was becoming invalid, it was quite disappointing to see the level of failure that happened as the case is. But what could we have done better, and how can we address this moving forward? I think we basically, first of all, have to understand that our problems are peculiar to us and our people are peculiar. And we need to stop adopting just global standards or global methodologies in attempting to solve our local problems. And what do I mean by that? If you think about someone who's had cash for a very long time, done business in cash, and all of a sudden this cash is not going to be valid anymore, and you ask them to go into banks. Now, they don't go into banks for many reasons. First, they don't trust banks. Some of them believe that their monies get reduced when they put it in the bank, and they feel it's safer under their bed, or even with what you call like the market adjust situation, as the case is. So we will continue to suffer now from even increased lower trust from what people have experienced. So in preparing for this better, I would say we need to now start thinking about new ideas and new ways. We don't have to take this from an incremental point of view. It doesn't have to be that banks that have served those who are educated, those who have been formally banked, are those who need to serve those at the bottom of the pyramid. We need to start thinking about what is the new infrastructure to enable everyone participating in the financial services. It doesn't have to rely on what exists right now, what exists today. We should have pretty much done some testing of our system. Can we undo? Can the policy, for example, when we put out this policy, can our systems today undo the impact of hundreds of millions of adults who will have the need to move money around or moving money into the financial ecosystem? I think that could have been done better. But just taking a future view to this, over time, most of the problems we're seeing, they are teething problems. Over time, most people will be able to access financial services from their mobile phone, from traditional banks, and also from fintechs, as the case is.
And Yomi, before I let you go, let's get into a space that's really your comfort zone with the work you've done with Softcom as well as Eyowo. There are some estimated over 200 fintech firms in Nigeria. They're providing online access to mobile payments, digital banking, and commercial and personal finance activities. They've really liberalized the financial services sector. But there still remains, depending on who you talk to, about 36 to 38 million unbanked, financially excluded adult Nigerians. So when it comes to digital finance and digital banking, which are not one and the same, even though many of us will probably use the terms and the phrasing interchangeably, where do they come into play when it comes to financial inclusion?
I feel that even though there are a sizable amount of fintechs who are building products and building platforms for people, and we've seen increasingly account opening, account ownership increase over the last decade. I think over 30 million Nigerians have gotten accounts, whether mobile wallets or former bank accounts over the last decade, mostly on the mobile wallet side of things. So I'd say that in some way, digital banking or the fintechs are addressing or closing the gap. But what we're not seeing is utilization and sustenance. And because we're not seeing utilization and sustenance, for us, it got us to getting closer to the problem that why are people not utilizing this? Why is this progress not sustained as the case is? And what you realize is that the problem is not just a case of a financial service. It's a social problem. It's a behavioral problem. People just don't see the essence or the need for in some cases for this product, or these products don't meet them at the point of their need. So if we approach a social problem in just a technical way, I think the outcomes are evident. People are opening accounts, utilization is growing, but we're not seeing any change in our poverty ratio. We're not seeing any change. We're not seeing changes in how people are included or the kind of services people have access to. So digital banking, I think it would obviously accelerate us gaining faster access or faster success in financial inclusion. And I think more fintechs can play at the bottom of the pyramid. For us, because we're built on the mobile phone, literally every single person who has a mobile phone has access to financial services in Nigeria. Everyone who, in some way today, can hold a mobile phone, can use a mobile phone, should be able to use those same abilities to bank. And all the work we're doing is to ensure that, from a technology point of view, from that mobile phone, in whatever form they can, they should be able to access financial services as well through their mobile phones.
All right, Yomi Adedeji, the co-founder of course, Softcom Limited, as well as co-founder of Eyowo, joining me as we look at deepening financial inclusion across the continent, but also touching base with some of the issues we've seen in recent times here in Nigeria, as the cashless policy, of course, as the revised cash withdrawal policy, and now the redesigned 200, 500, and 1,000 naira notes really kicked in with, of course, the deadline given by the CBN. Thank you so much for joining me on this conversation. We look forward to having you again.
Thank you so much.